is about what you'd expect to see.
It is, and boy, did they really forecast some gloom and doom, and the forecast for the United States that they had put out there is not
As
so
bad. Right.
as bad. Exactly. It's really countries out of the Eurozone, in Asia. Nonetheless, what their speak is across the board is that most central banks are going to be doing nothing, and if anything, become more accommodative. Certainly not, raising rates anytime soon whatsoever.
So, Scott, we saw rates which came off with the indices selling off and other concerns since the December lows. The ES, the NASDAQ, the Dow, the Russell have returned to, near the December highs, but rates have still yet to come back to the same extent. Is this telling us that investors are either skeptical of the recent rally back off the D's lows, or is it more a sign of what we just talked about and how lower rates are expected for some time now?
Well, I think we had such a quick switch of speak out of the Fed in their last announcement in December of, more to that dovish tone than we've seen, obviously, in the last 6-9 months, even a year or so, that really is what turned the marketplace for me, Ben. I think people are skeptical of the rally, but that quick stance, the position change that the Fed has taken, that's really gone front and center.
So, Scott, with all the talk about growth concerns, there's a lot of focus on China and a lot of talk about how without China participating, it'll be tough for the U.S. to march on and continue along the path that we have been. What about Europe? Because with some weaker than expected and desired economic data recently, and comments from Draghi last week hinting at, a move to, potentially more stimulus to come. I mean, ultimately, we need to want them to join in as well, right? We need them to join in order for us to continue on this path, correct?
I think we've been waiting for that for the last 12 to 18 months or so, and month after month we just keep seeing more and more dismal reports about their economic growth. Italy, France, I mean, it's really brutal coming out of the Eurozone here, and certainly the tea leaves, at least the expectations here moving forward, are not getting any rosier.
So, Scott, one of the things that sets us apart is our services sector, right? It makes up such a large part of our economy, but much like what we were just talking about in terms of the U.S. and it remains strong amidst some of the other weakness in China or Europe, can services survive or remain as strong if manufacturing starts to decline?
That's going to be a real tough one, Ben. The longer that we see the government shutdown drag on, the more that's going to lead into that. And right now, it's probably not that big of an impact on the service center, but if we get, going here another 2 to 4 weeks and there's no sort of positive movement in talks with China here, that's when you really may start seeing a big drag on that sector.
Yeah, I mean, initially we were hearing a very little impact in terms of GDP, but I agree with you. As things start to draw out and drag on, in theory, that could become larger or increase. Scott, big week ahead of us this week, not only in terms of economic data, but we have Bank of Japan and ECB. What are you going to be watching, and what should our viewers at home be keeping an eye out for?
I don't think they're going to knock down their currencies any further than they are right now. I don't think they want to come out and say, boy, our growth outlook, our growth estimates have really halted or come to a screeching halt here. So I'm going to be looking for their speak. What are they saying? What are they saying about the future here? Are they going to stay accommodative? What are they going to do about any sort of QE? But, I don't think there's going to be any sort of rhetoric whatsoever of any tightening coming out of either of those places.
So, Scott, a major driving force in the treasuries recently has been the indices, right? As the risk-on trade has been in effect as it is right now, it seems like recently, as of last week, or that risk-off that we saw throughout the month of December. Scott, with the Fed on hold until we hear anything different from them, should we look to the indices as the driving force there, at least for now, in terms of the treasuries?
I think we have to, at least over the next 2 to 3 weeks, Ben, till we get through earnings season here, and let's see what you know, the big S&P companies really say today's a big, or this week is a really big week, next week is a big week for these reports. Let's see how we fare through that. I expect some more volatility over the next 2 weeks, more so than we saw last week for sure. And then let's see what comes out of that, what the expectations are, that the drag on these big companies are from the tariff shutdown, from the issues, from Brexit even.